Hi, welcome to this Thursday topic of quant investing, which we have been talking about last month also, and even this month we'll be continuing on this topic. We just took a little bit of break for Diwali, and now we are back again with that. I would recommend that you keep take a look at our previous videos. This is what we have covered. We've demystified a bit of quant investing. Uh, what I feel it is at this point in time that it's still early in India, but it's been around for a while in the world. But we're still discovering the different layers. There is more art, less science, and that's precisely what we're going to talk about today. And how it is still investing uh, as a discretionary investor would add at its core, it's how it's executed that is the difference. And we spoke about factors. We introduced factors to you. We took an example of the RJ appearance factor, and then we showed how the market, if there was a relationship between the appearances by this fictional character called RJ on television, then that would be a factor affecting the market. Then we looked at the history of significant advances in the development of factors, and we went from it's actually been from 1934 onwards that factor investing has been in in practice, but it's only in the 1990s that really it took off after Pharma Friends sort of wrote their seminal paper, and closely followed by Jagdish and Titman, and then we had the paper in 97 by Mark Carhart, and ever since then, now we have fair amount of out of sample data to conclude almost definitely that there are factors they work, but as and when new data comes up, new findings come up, we look at different regimes, the views change, the nuances change, but not the overall effect and conclusion. This is how we told how factor changed the way alpha was measured for active managers. Today we're going to look at today we look at the point I alluded to earlier, that is fact there is a lot of art in factor investing. It's not all science. So it's the trend, a famous a very large trend following firm in Europe came up with an interesting paper called Does the Captain Still Fly? And they asked the question that with planes being so automated today, the word autopilot actually comes from aviation industry. So do planes actually fly? Do pilots actually fly the plane, or is it that they are putting it on autopilot and then letting it do its thing? So let's just take a look at that, and so they got asked this question in one of their due diligence events, saying that how would the investment manager characterize the basic trading approach for the strategy? What percent is discretionary and what percentage is systematic? So if you go in the paper and read, they say that 100% is discretionary and 100% is systematic. I mean, you could answer it either way, but what they say is that this trading discretion does not simply imply that we can do whatever we want. There is a boundary, there is a laid down approach that is much more, I would say, articulated more definitely than in the case of an discretionary investor. So what they say is that we offer the whole program, which includes the services of our entire team who implement the program. In this respect, our service is somewhat comparable with that of an airline, which uses planes, but it doesn't sell the plane. It offers flights, and it is the responsibility of the people working for the airline to ensure that its planes reach their destination. I would say this aptly describes what quant investing is. We don't we don't sell a set of rules, or we don't sell the model, or we don't sell that factor. What we are saying is that, look, we are going to implement that factor for you. The execution is a large part of quant investing. It's not just putting together a model and a set of rules and then just let it sort of make money for you in perpetuity. Things do change along the way. So with that, what I thought I'll do today is I took the different strategic indices offered by the NSE, by the S&P, BSE. So I thought I'll take one factor today, and that's my favorite factor, which is momentum. And within that, I'll show you, how even momentum can differ so much. So let's take the Nifty, the most popular one, on which there are quite a few products now, which is the Nifty 200 Momentum 30. So the basic ways in which it can differ is that the universe, how the stocks are weighed in that, what are the number of stocks in that portfolio or that index, and what is the rebalance frequency of that index, and what is the method of calculating that momentum score, what is the look back period and all of that. So for example, the momentum 30, the universe is the Nifty 200. Similar for the alpha 30, the universe is Nifty 200. But it's where the weighting, when we come to weighting there, the portfolio, there is a difference. Alpha based weighting is basically saying that if a stock ranked number one in the when you implement the process, so they're going to give it much higher weightage than the last ranked stock, with some caps, of course. So you can read the methodology document for that. But in a tilt weighted method, what you're doing is essentially taking the free float market cap and multiplying it with the momentum score. So in a way, it's a sort of a tilt away from a cap weighted index, which is a regular index, how a Nifty 50 or a BSE 30 is weighted. And then the rebalance period here is 6 months, whereas for the Alpha 30 index, it is every 3 months. The method also is completely different. The Momentum 30 takes the last 6 months returns and adds the 12 months returns and takes an average of that and divides that by volatility. The academic definition of momentum does not include volatility. A lot of products out there, a lot of PMSs, funds out there offer their momentum strategy saying it's momentum, but it's actually momentum plus volatility. We are one of the few who go out and say that it is a combination of two factors, which is momentum and volatility. It's not pure momentum as the academics would sort of define it, but then who cares about the details, right? So Alpha 50 again takes the universe. There is a top 300 by market cap. Again, it takes the alpha based weighting, which I described earlier. It has 50 stocks. The rebalance every quarter, and again, it takes Jensen's alpha as the method of calculation. The BSE momentum index is quite interesting. So it takes the BSE large and mid cap index as a universe. So I'm assuming that it's the top 250 by market cap. It is a tilt weighted index like the Nifty 200 Momentum 30 index. It again takes 30 stocks and it's rebalanced every 6 months. And it does not take into account the 6 month returns. It only takes into account the 12-month return. But it still divides the 12-month return by volatility. So this method of calculating volatility, which is smoothing the volatility, has become quite popular. It makes the ride much less turbulent. So I think a lot of people go for that. Now let's look at how these methods perform in and what is the difference. So you can see the momentum 30 on top and the momentum, the BSE momentum, more or less are the same, but the difference is that the BSE momentum takes into account only the 12-month returns, whereas the momentum 30 takes into account 6 plus 12 months. So you can see that the returns of the BSE momentum are almost 3% lower than that of the Momentum 30 for and so the risk reward ratio is also in favor of the Momentum 30. If you look at the Alpha 50, which takes into account the large and mid cap, so I'm guessing which is the top 300 by market cap which they've taken. There is about a 3%, again a 3.3% difference between Alpha 50 and the Momentum 30, and also approximately a 3.5% difference between Alpha 50 and Alpha 30. But Alpha 50, if you remember a few months ago, there was a product launched by a large AMC, and they ran into some issues with that because they could not buy the top two ranked stocks because they were fairly illiquid. And because this Alpha 30 and 50 do not take into account the free float market cap while deciding the stock weights in the portfolio, the tracking errors there may be much larger than what you may see in the Momentum 30 and the BSE Momentum Index. So, these are differences in construction. So you can see there are 4 different momentum indices. All 4 have different risk rewards. The Alpha 50 seemingly has a large risk reward at 0.84, but the implementability of that index or that method is questionable. So at this point in time, perhaps the Momentum 30 or the Momentum BSE Momentum looks far more implementable, and let's see how the Alpha 30 does if somebody does go out there and launch a product on that. So so you can see the amount of discretion that a quant also has, and and then once we choose these we choose these parameters and do our back test and decide which one to go with. That's a choice that we make. So that's something that one should be quite mindful of. So with that, we come to an end on today's topic. And just a usual disclaimer: there is not investment advice, purely for educational purposes only. And please consult your investment advisor before investing. And you can follow me on Twitter at Anish Daily, at QEDCap, and visit us at QEDCap.com. We've just put out our investor letter recently. And we're going to be publishing the factor report, a completely revamped factor report, either tomorrow or Saturday. And on Monday, we'll probably be covering that factor report. We've revamped it completely. So I think you'll be quite pleased. A lot more details, a lot more data out there in the factor report. So with that, the usual thing, you know what to do: like, subscribe, and follow our YouTube channel, and keep sending us your questions, and we're happy to answer them. Thank you.